Welcome to my latest episode of Damien's Market Update, the show where I talk about what's been going on in the investment markets and what to look out for in the days and weeks ahead. Now, it's been 6 weeks since I made the last episode, and since then the US dollars continue to strengthen after bouncing off the key support level of 101 before moving above its 200-day average. Now, this strength started to pose a challenge to the rally in US equities and ultimately global equity markets, and the resurgence of the dollar was linked to the market reassessing its optimism over US rate cuts following the publication of a number of economic data points and also hawkish comments from the Federal Reserve members. Now, this shift in rate expectations translated to bond markets, where we've seen the 10-year US Treasury yield rally to its 2024 high of 4.35%. Remember that higher yields mean lower bond prices. Now, despite the dollar rally raising concerns over the sustainability of the US stock market bull run, big tech came to the rescue of equity markets. Now, when we often refer to tech stocks, it's usually actually in reference to a list of so-called Magnificent Seven companies. Now, I'll call them Mag 7 for the rest of this video, but these are companies whose business models actually go beyond just being technology providers, and they include Nvidia, Meta Platforms, Tesla, Amazon, Alphabet, Microsoft, and Apple. Now, these 7 stocks account for over 27% of the S&P 500 and have been the driving force behind the equity market rally in the index in 2023 and 2024. You just have to look at the difference between the equally weighted S&P 500 and the normal S&P 500. The difference in performance is significant. Now, the Magnificent Seven themselves have been moving higher because of the likelihood or the market prediction of Fed rate cuts. It had been improving until very recently, but also because of the AI theme. Now, a string of positive blowout earnings results from some of the Mag 7, not all of them, has continued to propel the market higher as we head into March. Nvidia's earnings report last week was a pivotal moment for the company, but also the stock market more widely. Now, the outcome of that earnings report was being heralded as a judgment or validation of the sustainability of the wider market rally, but also of the AI theme itself. Now, that is especially true since the end of January. Meta and Nvidia have been really the two stocks that have been driving the market higher, with the rest of the Mag 7 not giving as much to that rally. Now, there were plenty of vocal commentators stating with somewhat surprising authority that Nvidia was going to disappoint with its earnings report and the stock market was going to suffer and we're going to have a deep correction. But what actually transpired is that Nvidia's earnings report smashed those really lofty expectations of analysts, and it reported a staggering 22 billion in revenue for the last quarter and forecast a further 24 billion in revenue for the next quarter, outstripping all of those expectations, and it underscored the insatiable demand for AI technology. Now, the earnings report appeared to validate also the bullish outlook for the stock market and AI tech stocks. Now, that pushed the S&P 500 to new all-time highs. We also saw highs for the Nasdaq 100, but also European and Asia markets weren't left behind as the stock Europe 600 and Japan's Nikkei 225 hit historic peaks. In fact, the Nikkei 225 surpassed the peak it set in 1989. Now, even Chinese stocks have rallied, and the laggard was the FTSE 100, and that's because of its relatively low exposure to tech stocks. So we saw that sharp rally in tech stocks, and in particular anything related to AI whatsoever, and that started to raise concerns among some commentators about the disconnect between valuations and fundamentals. Now, if you look at the dot-com bubble of 2000, there were excessive speculation on internet companies around that time, and that led to a market crash. Now, it's true that if you dig below the market surface, at the moment there is a deterioration in breadth if you look at certain indices or indicators. Now, by one measure of market breadth, the percentage of stocks within the S&P 500 that are outperforming the wider index has fallen to around 26% in recent weeks. And that is a level that we've not seen since the dot-com bubble. And actually, that was the level we got just before the dot-com bubble burst and the S&P 500 fell 50%. Of course, the trouble is that's only one indicator. Another indicator of market breadth is the S&P 500 200-day index, which calculates the proportion of the S&P 500 stocks that are trading above their 200-day moving average. So if you're still with me on that one, when this figure exceeds 50%, it typically indicates a bullish market sentiment. Additionally, particularly high or low values can indicate or assist traders in identifying conditions where the market is either overbought or oversold. At the moment, that indicator sits at 69%, which suggests market breadth actually is still okay, but that is still lower than what we saw at the end of January. So the point is, there are cracks appearing beneath the surface of this stock market rally, but not enough to confidently predict when a correction will happen. Now, one thing I want to finish on in this episode is just to point out the recent change in correlation between bond and equity markets. You may have seen that in your own portfolios. Now, up until the end of January, both assets were moving largely in tandem, as they have done for much of the last 2 years, which means that when they were rallying, they both did at the same time, and when they slumped, they both did that at the same time. But what we started to see since the end of January is them diverging. So we're starting to see a negative correlation once again, or in other words, when equities fall, bond markets rally. And we've not seen that really since before this rate hiking cycle that started at the end of 2021. So what it means is that we're seeing the stock market start to rule out the possibility of a second spike in inflation and higher interest rates. And it means that the market is starting to look at the next stage of the economic cycle, which means economic contraction and rate cuts. So if we've not hit the peak in inflation or the peak in interest rates, then the stock market is in for a shock. And if that happens, then that would likely cause a crash, particularly in those rate-sensitive tech stocks, and they might lead the charge on the way down. That is it for this episode of Damien's Market Update. As ever, any questions, do put them in the comment section on the YouTube version of this show, and please do like the video and subscribe to our channel.